biggest factors facing the economy is really looking at corporate earnings growth. Will U.S. corporations, the S&P 500, continue to grow going into in the third quarter earnings season? Additionally, what's going on in Washington is a sideshow unless politicians capitulate and actually allow a default of the debt. That is not going to happen. That's almost a zero probability. So I always want to focus on the fundamentals, and that's primarily corporate earnings. Often you look at valuation between equity markets and bond markets. Right now there's a concern with rising rates, and I actually call that the getting back to normal trade. That is, equity prices are going up commensurate with bond yields going up. That's a rising slope of the yield curve, and that's a growth story. That's actually good news. In that trade, we think there's a big gap right now. That's going to go back to normal. Rising rates and rising equity prices where the earnings yield converge to the treasury yield. That means investors should get out of defensive posture into a fully allocated posture. For instance, 60-40 investments, 60% equity, 40% bond. The disruption in Washington with this shutdown, with the debt ceiling, with the Affordable Care Act, the EPA regulation, I think the government is getting too involved in the economy. What I prefer is a much more free market approach. But let's look at the Affordable Care Act. The intention is to lower health care costs. Already we've seen that healthcare costs are lowering by themselves. What this does is create uncertainty for businesses. There's concern that if you're a 50-person small business, that if you're 51, you have a penalty if you don't pay for their healthcare. So what it does is it creates a burden for businesses. Instead of focusing on their knitting and doing business, they have to focus on all these regulations. That in itself is very disruptive and will slow growth. So my concern is great. Let's take care of the individuals that need health care, but let's not do it in a way that destroys jobs. In the next 3 to 5 years, what investors should be looking at is a broad global diversification. I advocate casting your net far and wide. Right now, emerging markets seems like an incredible opportunity. Why? They've underperformed for 3 consecutive years to the S&P 500. I call that a mean reversion opportunity or a buy low opportunity, and to add it to your portfolio or to add to it. What investors need to understand is that global growth is still strong and is being driven by the BRIC countries, Brazil, Russia, India, China, and the emerging market countries that I call pivot, Peru, Indonesia, Vietnam, Oman, and Turkey, because U.S. corporations, more than the big corporations, more than half their revenue now is overseas. So the global story will continue, even become more important in 3 to 5 years.